Hey guys, and welcome back to my YouTube channel. My name is Mihir, and in this video I'll be giving you a review of the Commsec Pocket App. This app is specifically designed for people who are unsure of what to invest in or that don't want to invest a lot of money up front right now. Otherwise, through Commsec, the first trade has to be a minimum of $500. After that, it's $100. Yeah, and I don't think a lot of people are up for that. Some of the benefits include for trading as little as $50 and having a brokerage fee of $2 per trade up to $1,000. The brokerage fees are good, however they progressively get worse as you invest tens and thousands of dollars per trade. This app is primarily targeted towards people who want to put some bit of their money into the stock market. Currently in this app we have 7 ETFs, and if you're not sure what ETFs are, I'll give you a quick rundown. Otherwise, I've already made a very detailed video on that, and I'll leave a link somewhere up here with the eye icon, so click on that. ETFs stand for Exchange Traded Funds, and essentially what they are, or what happens is that you give your money to a company, and that company pools your money alongside others investors' money and invests in a magnitude of stocks depending on the ETF's goal. For instance, I have ownership over an ETF known as Aussie Top 200, and you'll see it in the video. Otherwise, that gives me access to the top 200 companies on the ASX, so the Australian stock market. The top 200 companies have a small bit of my money invested into them. That's the power of ETFs. Another benefit of ETFs is that you can get into expensive stocks. Because right now, for example, the Apple stock costs 414 Australian dollars. Yep, 414 Australian dollars for one unit. And I don't think many people were up to that. With this, you can get a small ownership into Apple. You don't have to pay $414 for that one unit. You can get a small percentage of your money going there. The 7 ETFs are Aussie Top 200, Aussie Dividends, Global 100, Emerging Markets, Healthwise, Sustainability Leaders, and Tech Savvy. The first ETF you see is Aussie Top 200. It is a iShares Core S&P ASX 200 ETF. It's a simple low-cost way to invest around 200 of the biggest companies on the ASX, including the blue chips. If you click on Find More and Explore, you can see that currently it's $26.32 per unit due to the market being down. So what essentially happens is that an ETF tracks the market. It's not designed to beat the market, such as mutual funds, hence why it doesn't present as much results. However, it also makes it much safer because the market has always been going up in a positive trajectory. It may be down sometimes or plateau, but it always has gone up throughout historic history. And some of the companies you'll be investing in include Commonwealth Bank of Australia, BHP, Westpac, NAB, ANZ, Woolworths, Wesfarmers, and Telstra Corp. And if you want to find out more about things such as dividends, you come down here into more info about this ETF. Then from there you can see the fees. It's only 0.15% per annum, and that's deducted from the daily ETF's pricing. And the income varies amongst many ETFs. Since this one is focused solely on investing in the blue chip companies, you'll get a decent amount of distribution. However, there's one specifically targeted towards dividend investing. It says here, you'll be paid your share of this income quarterly. In the past 12 months, investors were paid 3.95%, which is, I presume, much higher than most of your interest rates. I don't know any interest rate that accounts or is 3.95%. But it will be much lower since the market has sort of declined due to the sea outbreak and bushfires. Those two have contributed significant amounts of damage. However, this is long-term investing, like I keep reiterating. So over 10-15 years, this will be 100% worth. And if you're unsure what dividends are essentially an income you get for being a shareholder of a company. And no company has any obligations to give you dividends, however some do, such as Commonwealth Bank, NAB, NZ, sort of the banks, and bigger companies generally tend to do that. So essentially where dividends come from is, say, a company essentially makes a profit, and they have a choice whether they can reinvest all of that into the business again, or they can distribute some of it to the shareholders. And you can be paid this either monthly, quarterly, semi-annually, or annually. It generally tends to be quarterly, as you'll see throughout these ETFs. However, some of them can be semi-annually as well. The second ETF is known as Aussie Dividends, MSCI Australia High Dividend Yield Fund. So it's essentially a ETF focused on dividends primarily. Some of the companies you invest in include BHP Group, Commonwealth Bank of Australia, Westpac, NAB, West Farmers, ANZ, and many companies. If you come down over here, you can see more info about this ETF. Investors in the last 12 months were paid 5.6% per annum, which is insane. Getting 5.6% on your money is, you can't get that through the banks. The only way you're going to get that is stocks, ETFs, or property, not through the bank's interest rates. No way. You can't save your way to wealth, people. And the expenses, like I said before, are deducted from the ETF's daily price. So the 0.35% per annum is deducted daily from the ETF's unit price. The third ETF I'll cover is Global 100, and it's an ETF owned by iShares. This ETF gives you the opportunity to invest your money into the top 100 companies currently listed in the world market. Some of the companies you're investing in include Microsoft, Apple, Amazon, Alphabet, Nestle, Johnson & Johnson, and Intel. I just want to say one thing. The thing with Amazon, if you don't know, Amazon's stock price is $2,000 just for one unit. With this, you have the option of investing in a company like Amazon, which is phenomenal. A pattern you may realize is that most of these companies are in the tech industry, health industry, or the financial industry. Now I'll direct you to more info about this ETF. And here you can see that investors were only paid 2.6% in the last 12 months. This amount isn't as much as you would think it would be, as you see in Aussie Dividends, Aussie top 200 companies. However, these big companies like to invest most of their profit back into the company. They do give a small portion to the shareholders, however, it's just a small portion. But another way you can think of this is that you're getting access to shares such as Amazon, Apple, Microsoft, and you can think about how much they will grow in like a 5, 10, 15 year time frame. So I guess that sort of negates with the dividend thing, because you can sell these later on, which is amazing. The annual fee is also 0.4%, which isn't necessarily too low or too high. It's sort of in between, but I guess it makes up for the returns. The fourth option is emerging markets, and this ETF is also given out by iShares. Through this ETF, you can get diversified access to 800 plus companies in the world's fastest growing economies like China, Taiwan, Korea, India, and more. Currently, I understand due to the sea outbreak, many people won't be happy investing in China. However, most of these companies also are in Taiwan, Korea, and India, like it says here. So if you come through here, you can see that it's currently $63.19 per unit. And before that, it was $66. It's dropped quite a few dollars in price, and I can understand people might not want to invest in this due to China's current economic positioning. However, I believe China will recover, and this will be a great opportunity. But other than China, investing in a plethora of companies in Korea, India, Japan, Taiwan, it's just amazing. With this ETF, you get access to Alibaba, which is like the eBay version of China. It's really amazing. You get Reliance Industries, you get China Mobile, you get Samsung. I'm pretty sure every one of you has heard of Samsung. So what I want you to do is navigate to more info about this ETF. And you can see here that the ETF paid the share of this income semi-annually, and in the last 12 months, investors were paid 3.23%, which isn't as high as Aussie Dividends, of course, because it's solely focused on dividends. However, the key thing about this is it's not giving you dividends too low or it's giving you too high. But a key factor about this ETF is that it's giving you access to untapped markets in Asia, 800 plus companies, which is insane. You can argue that yes, China is currently known as best state, but you got India, you got Japan, you got Taiwan, you got so many other countries in Asia that are just emerging out of nowhere. And as you may have heard on the news or something, India is one of the fastest growing economies. I'm pretty sure China was first, but due to this incident, it's not anymore. The expense for this ETF is slightly high, it's 0.67%. However, I believe it's still a great opportunity to invest in 100 companies, because I don't see where you get that opportunity elsewhere. And another thing you can think about is that those currencies tend to be much weaker than the Australian one. So the return we're getting is obviously much better. Another option we have is HealthWise. Judging by the name, I'm pretty sure you can understand this is going to be focused around pharmaceutical and health companies. So if we dive in, we can see that one unit is $101.05, which is insane. And obviously this ETF focuses on investing in medical innovation, It says with around 100 companies striving to help us live longer and healthier lives. However, the actual ETF is tracking 2,000 companies in sort of the medical market, which is absolutely insane. If we come through here, companies you're investing include Johnson & Johnson, United Health, Novartis, Medtronic, and Amgen. And obviously all of your money is invested into healthcare. If I come to the graph over here, you can see that the share price was $106. Now it's $101. However, it dropped to around $96, but it came back up. And that's what I've been trying to say to people. It keeps going back up. They had a sudden decline, but they're going to rise steadily and steadily again. And more investors are opting for this option as they believe, due to the C outbreak, that this will be beneficial for them. And it might be, who knows. So I want you to come and navigate down through more info about this ETF. And you'll see that the dividend rate isn't as high. It's only 1.95%. It's close to the global 100, but the thing with this is, due to the incident we have on the news, the world right now, many investors are full on just buying this like outright. Currently, I don't own any, and I believe it's not necessarily vital. However, if you think about it logically, many people want to live longer, want to live healthier, and many people are putting a lot of money into this. So this could be a good option for you. Even though it has a 1.95% dividend rate on the investment, it could grow. The stocks could grow immensely. And the expense rate is 0.47%, which is a good range. It's not too high or too low. It's a decent range, which I'm pretty happy about. Okay, this ETF is quite unique. This one is focused on sustainability leaders. So the companies that have a proven track record of being sustainable, and there's a plethora of variables that come into this. So let me show you. So as you can see, the ETF price is currently $10.31 per unit. This gives you exposure to around 100 leading sustainable ethical companies. And the sort of criteria they have is really strict. They want to make sure that the company investing is more carbon neutral than 60% of the industry. And they haven't been involved in things like harming animals, harming humans, underpaying workers. It's many things like that. So these are like the upper echelons of just like sustainable companies. They're really ethical. This is focused on people who are so concerned about ethical investing. So if you're one of those people, this is the right ETF for you. So if we come to explore, you can see that you are investing into companies such as Apple, MasterCard, Visa, Adobe, Nvidia, Netflix, PayPal. You're investing into like these amazing companies, and with this trend of sustainability gradually emerging more and more and more, I wouldn't be surprised if the public supports more of these companies and later starts boycotting some other ones, maybe to a lesser extent. However, the future is bright for these companies as of now. Now, if I just take you through the graph, you can see that the current share price is obviously $10.31. So if you look at its peak, it was $11, but when it crashed, it was $9.72, which isn't too much of a difference, almost $2. However, I just wanted to show you the impact of the recent C outbreak. So if we navigate down to more info about this ETF, we can see that you'll be paid your share of this income semi-annually. Okay, that's all right. But the problem is that in the last 12 months, investors were paid 1.33% per annum. You could go to ANZ, okay, a standard savings account, and all you have to do is deposit $10 every month, and you'll be eligible for 1.6 per annum interest rate, which makes this ETF seem a bit useless. This ETF is primarily for people who are really concerned about where their money is going. They don't care too much about money and profits. They obviously want some money out of it. However, they rather factor in their own beliefs of ethics into this. However, some people also claim that this is gradually becoming a trend, and over time, these companies will survive than other companies in the industry due to a greater fan following for what they're doing towards the climate and respecting people, rather than companies just driven for money and profits. The last ETF we have on this list is tech savvy, and ironically, not all of the stocks in this are related to tech, and I'll show you why. You can see that you're investing in an ETF called BetaShares Nasdaq 100 ETF, which aims to track the performance of the Nasdaq 100 index of companies. It is true Nasdaq is primarily composed of tech companies, tech giants. However, not all of the companies are tech giants. You can see that you're investing in companies such as Apple, Microsoft, Amazon, Facebook, Intel, Pepsi, Cisco, Comcast, just big companies. However, if you come down to industry coverage, you can see that technology is 45%. It's almost next to, obviously, 50%, almost half of it. However, you got other services such as communication services, consumer, healthcare, consumer defensive, industrials, financial services, utilities, real estate. So you have a plethora of options where your money is going, and hence why I like ETFs. So if we come down here, you can see that the highest price was on this was $24 until the market dropped to $21. So effectively $3 were lost, and you may be thinking $3 isn't that much. However, if you buy like 10 ETFs and 100 ETFs, you can see how much money you can save. So if we navigate down to more info about this ETF, we can see that you'll be paid your share of this income semi-annually, and in the last 12 months, investors were paid 1.04% per annum on their investment. This isn't looking too good, and the fees that are charged for this is 0.38%, and it can go up to 0.10% for expensive recovery to provide to ETF for the investors. So basically it can go to 0.48%, which is almost 0.5%, which doesn't seem too good. However, a thing you should consider is that you're investing in these massive tech giants, this Facebook, Amazon, Apple. These stocks have a lot of potential. So I guess the goal, or what this beta share is trying to provide to people, is that they can hold this maybe 5, 10, 15 years and sell it at a much greater price. Currently, these are all the options Commsec Pocket App is offering. However, in my opinion, this is one of the best apps to begin investing. There are other apps such as Raise and Spaceship, and I'll also make a video comparing them. However, most people would rather trust banks than trust random brokerages, and it's understandable. Ever since what happened to Robinhood, which was like an American brokerage thing that closed down for 2 days in a row when the C thing happened, people were frustrated. Also, if you want more information, I suggest you click on the 3 bars and then go down to the Learn option. And from there, this will provide you with more information so that you can familiarize yourself with the app and understand more about investing, specifically towards ETF. If you enjoy this video, please hit like, hit subscribe, and click on the notification bell icon so you don't miss out on any more of these videos I make. Thank you for watching.